Alrighty. So, welcome to Mazuma headquarters. Here we are, sunny Salt Lake City, ready to begin our webinar on 5 most often missed tax deductions and the things that will really save you taxes if you can catch. In preparing for this webinar, I did some research, went out and did the Google search for just the tax deductions that are being missed out there. And really no one knows what's being missed the most. But so I did the search, found a lot of lists, top 10, top 20, top 5, top 50. And it's really interesting because they just list the standard things that everyone gets: charitable contributions, mortgage interest. Did you know you can get a deduction for your dependents? Yes, we know that. We didn't forget we had a child. We're not going to miss that one, right? So I'm here today to talk to you about the ones that are really going to make a difference in your business on your tax return. The ones that can save you substantial money, okay? Not just a few bucks. So the top 5 begin with entity structure. Entity structure is kind of a little bit overcomplicated sometimes, but is that the S corporation is going to be most often the most tax efficient. So you are going to pay the least amount of taxes with the S corporation in general, okay? So let me switch over to my presentation here and share my screen with you so you can see the presentation that I've put together. And we will switch over. As I mentioned, beginning with entity structure, S Corp usually results in the lowest taxes overall. One of the big reasons why this is the case is there's no double taxation like there is with C corporations. Okay, now profits of an S Corp to self-employment taxes. But one of the big requirements of being an S Corp is that you've got to put yourself on payroll and you've got to pay yourself a reasonable salary. Okay, that's required to be compliant with the IRS law operations. Your tax savings with the S Corp come from only paying Social Security and Medicare taxes on the salary that you take out, as opposed to paying Social Security and Medicare taxes on all of your profits. All right, so that S Corp, for these reasons, will often be most beneficial for you tax-wise, and you'll end up paying the least amount of taxes. This is considered, in my opinion, one strategy that can result in very significant tax savings. I've seen this time and time again with new clients that come in. They will be saving $5,000 to $10,000 in taxes, just like that, from making the switch. Definitely not one to be overlooked. Now, it doesn't mean the S Corp is right for everybody. There's rules and things that have to be followed, and it may not be right for you. So just be aware, though, that most of the time it makes a lot of sense to be an S Corp. Our next one is the automobile, car expenses, right? If you're using a car purposes, then you should be getting deductions from that vehicle. Now, there's 2 ways to get deductions from the car. The first, mileage. Typically, IRS law changes from year to year, but typically you're getting between 50 and 60 cents per mile driven, okay, if you're using the mileage method. Realtors out there, you insurance agents out there, anybody who's driving on a regular basis or substantially rack up a lot of miles. I see realtors 25,000 miles driven, right? So that adds up to $15,000 in deductions, you're in the 25%, 35% tax bracket. That's, you know, $3,000 to $5,000 of tax savings. And you wouldn't think it, but it's common that this one is forgotten about. The mileage deduction isn't tracked on a monthly basis, you know, in your bookkeeping. And so it's something that has to be reported all at the end of the year, your overall miles. And so sometimes it can fall off the radar and you forget about it. Don't forget the mileage deduction. The other, if you're not doing mileage, the other method is to go with actual expenses, right? So as opposed to counting how many miles and doing 50 to 60 cents per mile, you would be adding up all of the gas, insurance, and repairs expenses that you actually pay for throughout the year. And in addition to those, you depreciate the vehicle typically over 5 years. So you get additional deductions above and beyond the gas, insurance, and repairs for depreciation. If you're leasing the vehicle, you deduct the full lease payment. So those are the two ways auto deductions work, either with mileage or by keeping track of actual expenses. Either way, the auto deduction can result in very significant tax savings. Again, this is a big one. $3,000, $5,000, $8,000 tax savings depending on the situation here. So don't miss that one. Next, retirement plans. The SEP IRA is the one I wanted to focus on here because it's easy to set up and there's no annual filings. It's really cheap, right? It's really simple and cheap to set up. The employer, the company, is the one that contributes to the IRA. So in order to set this up, you want to meet with a financial advisor. They get it all set up for you, and the employer will, the business then is the primary one that contributes into the plan, and you can contribute up to 25% of the employee's compensation. So you have an employee or you yourself as an employee of the business are making $100,000. You can put $25,000, the SEP IRA, up to $54,000 in 2017. So the $54,000 is the max. So 25% of an employee's compensation up to $54,000 for a year. Now, one thing to remember is that the company has to contribute the same rate for all employees. Okay, so if it's not just you in the business, you've got 1, 5, 10, whatever it is, and you're contributing 25% of your salary into the SEP IRA, you will need to also contribute 25% of their salary into the IRA. So keep that in mind. LLC owners or sole proprietors can set up a SEP IRA also, even if you're not an employee of the business. This still works for you. There's a separate calculation that you have to do, but it pretty much works out to that same 25% max numbers, 25% of your profits it would be. This is another big one, you know, getting $25,000, $50,000 into a SEP IRA, that's all that's a tax deduction. Now, you're taxed when you pull it out later, you know, in retirement. You can't touch the money until retirement. When you pull it out, you're taxed. So there's a debate on whether that's the best strategy or not. But as far as saving taxes now, SEP IRA, it's a great way to get money into retirement and reduce your tax bill now by a substantial amount. The fourth item that I wanted to address is self-employed health insurance. Okay, without a business, health insurance premiums are itemized deductions. So just any old individual employee out there who does not have a business can only deduct these as an itemized medical expense. Okay, big problem with that. Your medical expenses must first exceed 10% of your AGI before they even start counting. All right, so if my AGI is $50,000, meaning about my income is $50,000, I'd have to have more than $5,000 in medical expenses before they even start helping me. So not a great way to save taxes without the business. But if you have a business with self-employment, you're able to take 100% of those premiums as a deduction on the AGI adjustment schedule, page 1, line 29 of the personal tax return. Okay, this is not a business deduction. However, you get it on the personal return because you own a business. Okay, so you get to deduct all of your insurance premiums. No more threshold, no more itemized threshold, but you get to deduct all of them if you own a business as an AGI adjustment. All right, so, you know, with premiums these days costing $700, $800, $1,500 a month, that can be a big deduction for us, and one you don't want to miss. So if you are paying for your health insurance and you own a business, make sure and deduct your health insurance premiums. Page 1, line 29 of the personal tax return. One little note, we're seeing more and more people are using health share ministries for their health insurance coverage. And, you know, it's exempt from the marketplace fines and everything. Those are not considered health insurance premiums, and therefore the same way, this way. Just a note to throw out there. The last item I wanted to mention is what I call previously personal expenses. Okay, things like cell phone, your computer equipment, any office expenses, your home office, all these things you don't get a deduction for unless you have a business, right? So Joe Schmo out there who's just an employee doesn't get to take deductions for the computer that he buys or his home office. So, but with a business, you can. These are smaller usually, you know, a few $1,000s a year is typically what they add up to. Cell phone, computer, you know, if you buy a nice computer, it could be more. But in the home office, it's substantial, but it's not nearly as big as like the auto or those other deductions. So this one's a more moderate tax savings. It results in a more moderate tax savings. Definitely still one you don't want to miss. So don't forget, if you didn't have a business before, you were probably paying for things out of your personal account that are now like your cell phone, like your computer, any equipment or supplies you use in your business. All right. Those are the 5 that I've got for you today. They are substantial. They can make a huge difference in your tax bill. These are common for me to find. You know, we're running through the tax return with a client. They owe $5,000, which is more than they thought or want to pay. And we kind of punch down this list and can often knock a few $1,000s off because there's these extra things that we're finding out there. And this is really my top 5 that I go to. So you can find them too. And I would recommend always reviewing for these things or asking your accountant about them if they're not already on the radar. All right. The 5 in review are making sure you are structured properly, S Corp usually being the best option, automobile expenses, choosing the mileage or the actual expense method, but always keeping track of how much you're using your vehicle for business. It will result in a significant tax deduction. The health insurance deduction for the I'm sorry, I skipped the IRA deduction, the retirement plan. SEP IRA usually being the best for small business owners. Health insurance it was only deductible before as an itemized deduction. Now it's deducted on fully deductible if you're self-employed. And last, those previously personal expenses. Don't want to miss those extra things, though they may be smaller, those extra things that can knock a couple $1,000s off of your tax return. I will throw in here at the end a word about planning. Okay, so if you're making money in your business, we've got a couple more minutes. If you're making money in your business, you're going to owe taxes. You're going to have to pay taxes somewhere along the line. There's no ethical, legal way to get out of that. Okay, so if you've done all these things to make sure you're paying as little as possible, then zero in on the amount that you're going to owe and start planning for that. All right, find a way to look ahead when you've still got 6-8 months before the year ends, or 6 or 8 months before you file your tax return, and say, okay, it looks like after I've done all these things, I'm going to owe $3,000 still. What can I do now over the next 6 months to plan for that? So much easier to put $500 away per month and be prepared when it comes time to file the tax return than to scrape and scramble when it's time to file and say, oh, I got to come up with $3,000. I got to find a credit card that has a credit limit left on it still. And you just don't want to mess with that. And that's why we always push our clients to have tax discussions with us. We want to talk to you October, November, so that we can tell you where things are at, what it's looking like, and how you can prepare for the tax bill. All right, so don't go blind. It's easier to just not think about it until you have to, but it's definitely not more comfortable. There's no benefit from putting it off. It's so much better to look ahead, talk to your accountant, find out how much the tax bill is going to be, and then begin planning for that. Okay, makes it so much easier. Now we're about to wrap up here. Just want to let you know that you can email us your questions anytime about this presentation or about other tax questions that you have. If you're a Mazuma client, you can set up a tax discussion at any time. Be happy to take 30 minutes with you and project your taxes and figure out what it's looking like for your situation. I encourage you to do that. Email address is info@mazumausa.com, and we hope to hear from you soon. Thanks for joining us in the webinar. Look forward to seeing you next time. Take care.